Coal India Limited stands at the center of India's energy strategy, meeting around 80% of domestic demand. Despite a global shift toward cleaner energy, Coal India's relevance continues to grow as India's power needs surge. In 2024, India's peak power demand hit 250 gigawatts, about 70% of which was met by coal-fired plants. With electricity demand expected to rise another 9 to 10% in summer 2025, the pressure on domestic coal supply is mounting. Coal India, as the nation's largest coal producer, plays a vital role in meeting this growing need. While India targets 500 gigawatts of non-fossil fuel capacity by 2030, coal still fuels nearly 3/4 of India's electricity generation. And with over 75% of the country's coal consumption going into power production, Coal India's output remains indispensable. But the company isn't without challenges. Environmental scrutiny is intensifying, global coal prices are volatile, leading to financial pressure, and regulatory shifts toward clean energy could gradually erode its long-term dominance. Does it mean that the coal giant is losing its shine? Let's find out. Welcome to Bottom Line by Groww. In today's episode, we dive into Coal India's role in India's energy future, its leadership, financial performance, growth plans, and its pros and cons as an investment opportunity. Let's start with the domestic coal production. In March 2025, India surpassed 1 billion tons of coal production for FY 24-25 for the first time, achieving the milestone ahead of schedule. With the world's fifth largest reserves and the second highest consumption, coal contributes 55% to India's energy mix. This surge led to an 8.4% reduction in imports. Yet, imports continue to remain significant. In response, the Ministry of Coal is targeting a 42% increase in domestic coal production from 1,080 million tons in FY 26 to 1,533 million tons by FY 31. Backing this effort, the Union Budget 2025 allocated 501 crore rupees to the Ministry of Coal, a 255% increase from the previous year, supporting infrastructure, exploration, and sustainable mining. While the government is taking efforts to scale up its renewable energy, progress is slowed by challenges such as land acquisition hurdles, financial constraints, and the need for advanced grid infrastructure to handle variable energy sources. Moreover, the long operational life of existing coal-fired plants, deeply integrated into the energy system, makes an immediate transition impractical. As a result, coal will continue to play a critical role in India's energy mix for the foreseeable future. This brings us to Coal India. The coal production in India is led by three key players, with Coal India contributing to the lion's share. Private and captive producers contribute around 16% of India's coal production, delivering about 153 to 173 million tons in FY 24. Singareni Collieries Company Limited, SCCL, a joint venture with the Telangana government, accounts for 67% of national production. Coal India Limited, the undisputed giant, contributing over 80% of the national output. It holds about 48% of India's proven coal reserves. Let's take a closer look at Coal India, a dependable stock in many investors' portfolios. Coal India Limited is not just India's largest coal producer, it is the world's largest. A Maharatna PSU under the Ministry of Coal plays a pivotal role in securing India's energy needs. Now let's take a look at the financials of this company. The company had been reporting good numbers over the years. Net profit has grown at a 43% CAGR over 3 years and a 16% CAGR over the last 5 years. Operating profit margin has also improved steadily from 11% in FY 18 to 34% in FY 24. This financial strength fueled a massive stock rally, especially in the last 3 years. Coal India's share price soared 312% between January 2021 and a peak in August 2024. Coal India's performance in recent quarters has been impacted by both seasonal and structural challenges. Coal mining operations typically slow down during the monsoon and extreme summers, leading to temporary production dips. Beyond seasonality, the company has faced persistently high inventory levels, reaching a record of 95 million tons, which have weighed on its offtake. Offtake refers to the total volume of coal that is actually sold or dispatched to the end users. In Q3 FY25, Coal India reported a 17% YOY drop in its net profit, driven by lower fuel supply agreements or FSA deliveries and weakening realizations. In Q3 FY25, FSA deliveries fell by 1.5 million tons, reducing sales by 235 crore rupees. At the same time, the average price received under these agreements declined by 18 rupees per ton, cutting another 299 crore rupees from revenues. This apart, the global coal prices, which were stable around $150 a ton until September 24, fell sharply to $94 per ton amid the weak demand from China and global oversupply. Margin expansion at Coal India is closely tied to the global coal prices, as stronger international prices support higher e-auction premiums and realizations. As such, the correction in global prices led to import substitution, depressing e-auction premiums because domestic coal prices were higher than imported coal. This led to a fall in realizations, which in turn impacted margins. Margins declined to 34% in Q3 FY25 from 36% a year ago. E-auctions let power plants, steel mills, and other buyers purchase coal on the spot. In Q3 FY25, these auctions moved an extra 3.48 million tons of coal, helping to boost the overall sales. However, the price fell sharply from 3,321 rupees per ton to 2,671 rupees per ton. A reason for the fall in price can be due to more private and captive coal producers who have entered auctions, driving competitive supply onto the spot market. But despite these near-term headwinds, Coal India's dispatches remain strong in Q3 FY25, supported by ample inventory buffers. However, with imported coal staying cheaper, margin pressure and offtake risk will likely persist in the coming quarters. Since costs in mining are primarily fixed, margins are significantly correlated with production volumes. Lower volumes lead to lower operating leverage and compressed margins. That said, a pickup in global demand could firm up import prices, supporting Coal India's margins. Additionally, rising domestic coal demand may help the company capitalize on its high inventory levels, boosting the overall performance.
Coal India delivered a steady performance in Q4 FY25, recovering from a weak first half. Overall, realizations remain nearly flat, down 0.2% YOY, with total volumes at 201 million tons, down 0.1% YOY. While e-auction premiums softened throughout FY25, higher volumes helped mitigate the impact. The FSA segment saw a drop in quantity, but higher prices per ton helped offset the decline. In the March quarter, net sales declined slightly by 0.3% year-on-year, but rose by 5.6% sequentially. Despite muted top-line growth, PAT rose by 12% YOY and 13% QOQ, driven by cost efficiencies and a better price mix. Analysts believe Coal India will benefit from modest volume growth in the coming years, supported by 32 gigawatts of coal-based power capacity under construction. However, this upside may be partially offset by the absence of FSA price hikes, stable e-auction realizations, and rising cost pressures, especially from inflation-linked wage increases and provisions for a potential wage revision expected in FY27.
So what lies ahead for Coal India? To sustain and enhance its market position and future growth, Coal India is implementing several strategic projects. Number 1, first mile connectivity projects. Coal India Limited is investing heavily in mechanizing coal evacuation via 75 FMC projects, aiming to boost the mechanized dispatch capacity from 151 MTPA to 988.5 MTPA by FY30. These initiatives aim to cut costs, improve logistics, and reduce environmental impacts. Also, about 52% of the coal dispatch is done via rail, which is the largest mode of transportation compared to road, merry-go-rounds, and conveyors. As such, Coal India is investing in new rail lines to expand coal transport capacity, aiming to improve logistics and reduce delivery times. Number 2, Mine Developer and Operator or MDO engagement. Coal India is partnering with private players to manage mines through MDO contracts. This is a way to engage private companies to develop, operate, and manage mining operations, bringing in private investments and expertise. It plans to engage 15 MDOs across 28 projects, targeting an additional 170 MT capacity. Number 3, Revival of underground mines. Coal India has identified 34 discontinued underground mines with a combined peak capacity of 17.8 million tons per year and total extractable reserves of 267.5 million tons. As part of its revival strategy, 24 of these mines have already been awarded to private operators on a revenue-sharing basis, aiming to restart production through a collaborative public-private model. Number 4, diversification into coal to chemicals. Coal gasification is emerging as a strategic diversification. This offers a cleaner route by turning coal into syngas for synthetic natural gas, fuel, ammonia, and petrochemicals. The Ministry of Coal's mission aims to reach 100 million tons of gasification capacity by 2030. In FY24, a joint venture agreement was signed between Coal India and GAIL to set up coal to synthetic natural gas businesses. Number 5, renewable energy push. The company has formed a 50-50 joint venture with EDF India to develop renewable energy projects in South Asia, focusing on pumped storage hydropower. The company is in the process of developing a 5-gigawatt solar energy development program. Challenges for Coal India. Coal India is a giant that holds a near monopoly position in the energy mix of India, but even giants can stumble. Despite its financial strength and diversification progress, the company faces some challenges ahead. Chief among them is India's transition to renewable energy. Even though coal-based power generation is likely to dominate India's power needs, renewable energy is slowly making inroads. The slow transition toward green energy could make investors nervous. However, as India's move toward $5 trillion economy, the dependence on thermal power plants will be high for the continuous power supply, thereby driving coal demand. In this regard, Coal India is expanding capacity too. Another point of concern is the environmental and regulatory pressures. The company has faced scrutiny for environmental lapses in the past. Coal mining is also a major contributor to air pollution and CO2 emissions, key concerns as India tightens its climate regulations. In this regard, Coal India has started to diversify its business and is trying to reduce its carbon footprint. Additionally, the growing competition in the market is another concern for the company. The creation of a coal trading exchange and increasing private sector output, projected at 350 to 400 million tons by 2030, could erode Coal India's market dominance. To meet growing demand in India, Coal India is investing around 16,000 crore rupees annually to boost production towards 1 billion tons by FY26. So, is Coal India an opportunity or is it time to be cautious? Coal India's current PE ratio of 6.9 times April 2025 is significantly below its 10-year median of 7.7 times, suggesting it may be undervalued relative to historical terms. However, while Coal India offers compelling mix of scale, financial strength, and strategic initiatives, investors must balance these positives against structural risks from clean energy transition, regulatory scrutiny, and competitive pressures. To add on, Coal India has long been a strong income generator, offering high dividend yields, currently at 6.5%, and regardless of share price movements. This dependable cash flow can anchor a portfolio. But while Coal India's yield remains generous, it has slipped from double-digit peaks of 11.7% in FY20 to just 5.4% in FY24. This steady decline in yield suggests investors should temper their optimism with a touch of caution. Do you have Coal India in your portfolio? If so, what are your reasons for holding the stock? If you don't own this stock, would you consider investing? Leave your thoughts in the comments section. For more such insights, remember to subscribe to Bottom Line by Groww.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and/or other instruments traded on the stock exchanges.